In the previous episode of this podcast, I discussed why basic financial literacy is key for creative professionals and the agencies they run. I also discussed a few ways that you can increase your business and financial acumen. So if you haven't listened to that episode, maybe pause this one and go back and listen to that one. It's fairly short. It's only about 28 minutes. But in this episode, I want to dig deeper into some of the specific key performance indicators, or KPIs, that every agency and creative professional should be familiar with. Some of these KPIs are directly financial, meaning you could look at your financial reports, your profit and loss statement typically, to see them. These are where financial acumen and understanding of financial concepts is really important to understand these KPIs, but really all KPIs are ultimately going to come back to a financial understanding of how the business is doing. Some KPIs are non-financial, meaning you won't see them in financial statements, but you should be tracking them somewhere. So these are typically data that you're pulling from other sources within your business, typically from your sales platform, maybe from your marketing efforts, but those KPIs, those non-financial KPIs, are going to be just as critical as your financial KPIs, because the really interesting KPIs are this third set, which I call constructed KPIs, meaning they combine both financial and non-financial data. These are super interesting because they show us how directly linked our work is to the financial outputs. After all, the purpose of a business is to generate profit and cash flow for its owners. That's the ultimate purpose of a business. A business has to do lots of other things in order to operate. Of course, it needs to do a good job of serving its customers. It needs to build up its brand awareness. It needs to keep good records and stay compliant with state and local and national governing authorities. But ultimately, at the end of the day, the reason we start businesses is to provide profit and cash flow for owners. So we need to connect the work that a business does with its financial outputs. And I'm going to discuss this more later, but ultimately, the key for you as a creative professional, as a creative agency owner, is to recognize that because the primary purpose of a business is to generate profit and cash flow, your job, both inside your business and when it comes to dealing with your customers' businesses, is to make a business case for the work that you're doing. And in order to do that, your understanding of both financial concepts as well as the key performance indicators or KPIs that are built on those financial concepts is going to come in and play a critical role in providing that business case for doing business with you. There's another reason that you need to understand business finance at least as well as your customers do. Now, I'm a virtual CFO for creative agencies, and I'm also an accountant. So it's my job to know finances. It's your job to know your business and industry, which is hopefully not accounting. Unless you're an accountant listening to this podcast, which is fine, I appreciate that. But I'm primarily speaking to creative agency owners here. So you're probably working in web design or social media or lead generation or some field other than accounting and finance. So I don't want to train you to be an accountant. I'm not asking you to learn bookkeeping and taxes. I'm not teaching you how to do my job. But I do want you to understand and know finances well enough to sell to people who rely on their accountants and CFOs to make business decisions. The same way that you are hopefully working with an accountant and you're running your financial and tax and business questions by that accountant or by that CFO, your customers are doing the same thing. And when you send them a proposal to do business with you, there's a potential that they're going to run that proposal, or they're just going to float the idea of hiring a new marketing service or a new web design service. They might run that by their financial advisor. So to sum up, I'm not going to train you to be an accountant, but I am going to train you to sell to people who listen to their accountants. Those are the kind of customers that I want to work with, and those are the kinds of customers that I want to help you work with. You want to work with customers who are relying on their advisors. I just wrote a blog post last week about the 5 kinds of advisors that you need. You can go to my website, jwillcfo.com/blog, and find that post on the top 5 advisors you need in your business. And one of those is, of course, the accountant or the CFO. I want to work with customers who rely on me and my expertise to help make their business decisions. You want to work with customers who are probably doing the same. So I want to help you sell to those kinds of customers. That's what I want to do with this podcast. I want to give you the understanding and the tools you need to make a solid business case for doing business with you. I think that's a potentially huge differentiator in today's creative agency marketplace. I think a lot of creative agencies are trying to make a case for doing business with them. What you can do is already have that case made. And ultimately, it comes down to understanding the financial concepts and implications of working with you and being able to walk your prospective customers through that decision-making process, relying on the financial side of making a case of doing business with you. Because at the end of the day, you're asking them to give you money. So it's ultimately a financial decision. Do they want to give you money? And if you can make a business case based on a solid understanding of business finance, then you're much more likely to get a yes to that proposal or to get a yes to that pitch. So with that, let's get into this episode topic, the top KPIs for any creative agency or any creative professional. You need to understand these KPIs. So KPI number 1 is revenue. Now this first one seems pretty intuitive, right? Revenue is obviously an important metric for any business, but it can actually be a lot more complicated than you realize. We're not just talking about the total amount of cash that the business brings in from its customers. That is the basic definition of revenue, but we can get a little bit more complex than that. So first, there's gross revenue, and then there's net revenue. Gross revenue is your top line. This is all of the cash that you bring in. This is the sum of all the payments that you've collected. Net revenue takes out discounts and refunds. Now, some of this might seem that's already included, right? If you put a discount, then you haven't collected any additional cash. So what would be the difference between gross revenue and net revenue when it comes to discounts? I think you should be booking gross revenue as your pre-discount prices. So if you agree to sell some service or to start a relationship with a customer and you bill them $5,000, but really that was a 50% discount on the normal price of $10,000. I think $10,000 should be what you record as revenue, as gross revenue, and then you should have a separate line that shows a negative $5,000 discount so that your net revenue would be the $5,000 that you actually collected, but your gross revenue is $10,000. I think this gives us a more accurate depiction of what's really happening in your business. A lot of times, gross revenue is just reporting the net collected payment, but I think that's misleading, especially if you are routinely or regularly, or even if more than just occasionally, offering discounts. Now, I hope you're not regularly discounting your prices, and I think most service agencies and most of my customers that I work with, they're not typically discounting. But if you do ever offer a discount, whether that's part of some promotion or you structure your pricing in a way to where maybe you're giving an upfront discount if the customer pays for a year's worth of subscription or maybe pays the entire project billing upfront, and so you're going to build in, even if it's a moderate discount, even if it's a 10 or 20% discount, I still think you should be reporting the undiscounted price as your gross revenue and then booking the difference to a discount line on your P&L. And then also refunds. You've collected the payment, but maybe you had to refund it because the customer decided not to work with you, or you decided you didn't want to work with the customer, or for whatever reason you gave that refund. Again, you should be reporting the gross payment collected, or the actual price that you charged as gross revenue, and then separately reporting the refund. That should actually be listed as a negative amount on your P&L, not as just a reduction in gross revenue, similar to discounts. Now, why should we break these out? Because I want to be able to differentiate between gross revenue and net revenue. Now, net revenue is going to be your gross revenue, or the total price that you charge and expected to collect, minus any discounts that you offered and refunds that you paid back. Because I want to be able to go back and see, are you actually collecting the prices that you've charged? How much of a difference is there between the prices that you're setting for what you're selling and the payments that you're actually collecting and keeping? This is why refunds is taken out of net, because if you charge $10,000, but then you end up refunding $10,000, you really haven't gained anything, but you did collect that $10,000. You sold $10,000 worth of product or service or whatever it is that you're selling. So I want to see that you sold $10,000 worth, but I also want to see that you refunded that $10,000. So we're not going to include that $10,000 that was refunded in your net revenue, but I would want to see that in your gross revenue. So that right there is an important KPI. What is the difference between gross revenue and net revenue? Are you actually collecting most of your gross revenue in payments, and are you keeping that amount? So I would expect to see some discounting, some occasional discounting. I would even expect to see some occasional refunding. It happens. You get an upset customer, or you realize that a new customer just isn't a good fit, or that you sold them something that wasn't actually what they were asking for. There are lots of reasons to give refunds that aren't necessarily a negative statement about you or your business. And so we need to be reporting that accurately. However, if I'm looking at your P&L and you're collecting gross revenue of $100,000, but you wind up discounting or refunding to the tune of 5, 10, 15, 20%, something might be off. Something might be wrong. We might have a bigger issue that we need to address. If you're only having to discount or refund a couple of percent, then that seems pretty normal. So that's going to be one of the first KPIs I'm going to look at. This would be important for your customers, because if you're setting them up, let's say you're setting them up with a marketing campaign, or you're setting them up with a landing page that's going to be part of their new website, and it's going to start pulling in gross revenue, but then because there was a 30-day money-back guarantee, say on the product that's being sold on that landing page you built, and a lot of those refunds were being issued. Is this a problem with the product? Is this a problem with the landing page? Maybe something in the landing page was misleading and caused people to buy something that they thought was going to be different. We need to figure out what the story is, and that will take more work, but we need some sort of indication, some sort of indicator. That's why we call these key performance indicators. They're indicating either a problem or something is actually working. Right? They're indicating something that we need to then go in and figure out what is actually happening. So looking at gross revenue versus net revenue is definitely one of these. We can also start to construct KPIs using revenue as a base, such as average revenue per customer. So if you have a sales platform such as Stripe, where you know how many unique customers you have coming in based on different email addresses or different delivery addresses, then you can look at your total revenue, whether you want to use gross or net. I would probably use net here, but you would take that and divide it by the number of customers. Actually, you might want to use gross for that, because if you make a refund to a customer, then you would probably want to control for that in revenue. And so you'd want gross revenue. What's the average amount of gross revenue per customer in your book? That's one constructed KPI that you could use. And that right there could be a metric in your customer's business that you could try to improve with your customer. Maybe your customer's average revenue per customer is relatively low. Maybe it's $100, maybe it's $200, and maybe that customer is trying to work with higher value customers. And so you're looking to build a marketing campaign or a website that's going to drive more higher value customers so that you can get the average revenue per customer up to $400, $500, maybe even $1,000. That's one way that you could use a KPI based on revenue to start generating some real business change for your business or for your customers' businesses. Average revenue per sale is another one. This is going to be similar to average revenue per customer, but then we might be looking at repeat customers, and that's part of another KPI that I'll talk about later. And then another interesting one, and this is going to be particularly important if your business or if your customer's business has employees, this is average revenue per employee. By the way, when we say employee here, we usually mean what we call full-time equivalent, or FTE. This helps standardize how we report part-time employees. So think about having a business where you employ one full-time employee working approximately 40 hours a week, but then you have two part-time employees, and each is working 15 to 20 hours a week. It wouldn't be fair to the full-time employee to count the two part-time employees as also full employees, because they're not really. In terms of their contribution to the business, at least in terms of hours, they are not equal. So we need a way to balance that out. And typically what we would do is we would say that the two part-timers are working roughly 20 hours a week, which is half of the number of hours we expect out of a full-time employee. So each of those part-timers only counts for 1/2 of a full-time equivalent employee. So really what we have is one full-time employee, two half-time employees. And so even though we have three different employees on payroll, we actually just have two full-time equivalents. And that could be a really interesting metric. Sometimes I'll run into agencies where they've hired too fast. And they'll come to me looking for help because they're not making much profit and the owners are stressed out. And one of the first things I'll do is just compare the revenue they're bringing in to the number of employees that they have. Again, trying to convert that into full-time equivalent employees. If I'm seeing a business that has $200,000 of revenue per full-time equivalent, that might be reasonable. Depending on the size of the business, it might be low, it might be high. It just depends on the business. But compare $200,000 of revenue per FTE to a business bringing in $80,000 of revenue per FTE. Now we have a problem. Because most full-time employees in today's market, especially for creative agencies, they're going to get paid salaries of hopefully at least $80,000. If you want to go out and hire a full-time employee today in late 2022, you're probably going to be paying a salary on the order of, and this is going to vary across the country depending on exactly what industry you're in, what role you're hiring for, what region of the country you live in. But again, you need to be comparing what salaries you would be paying to your typical full-time employee to how much revenue a full-time employee brings in on average. Because if we hire somebody and agree to pay them a salary of $100,000, but our average revenue per full-time employee is $80,000, we've set ourselves up to go broke. And I've helped and advised businesses that got themselves into this situation, and we had to lay people off because that was the only way to right the ship. And it ended up that a lot of those hires were actually in non-fulfillment positions or non-operational positions. They were hired in marketing, in sales, maybe even over in administration. And these are positions that owners need to essentially come back into the business full time and work on. Now, I ultimately want owners to be working themselves out of jobs in their own businesses. I want them working on the business, not in the business. But if you don't have the revenue to pay an employee to do these jobs, to the point to where your revenue per full-time equivalent employee is below what your average salary per employee is, then you really don't have a choice. You've got to lay some people off and get back to work inside the business. And unfortunately, that's happened with a couple of clients of mine, and we had to figure that out. And it's not a situation you want to find yourself in. So if you can be tracking that KPI to begin with, now if your job with your customers is to boost revenue, then this might be an important metric. You might want to be asking them, even if it seems outside the scope of what you're working on, you might want to be asking them, how many full-time equivalent employees do you have? What's your top line revenue? To get an idea of what kind of return they would get. This might also help you make a good business case for working with you if you are a fractional or virtual or outsourced CXO. So for example, I work as a fractional or outsourced CFO, so I often am comparing the amount that I would charge a prospective customer to what they would have to pay a full-time in-house accountant, for example. So if I'm trying to sell bookkeeping and accounting and maybe some advisory, business financial advisory services to a potential customer of mine, then I need to be making a business case relative to what it would cost them to go out and hire essentially somebody that would be doing that work in-house. So if you're looking at revenue per FTE, you might have a situation where the customer looks and says, we can't really afford to hire someone full-time to do what we're doing, especially if you're, say, a fractional CMO, and they're thinking about bringing on a full-time marketing person to help run the marketing department for their business. You might be able to make a good business case for working with you as a fractional CMO as opposed to hiring in-house. So that's a way that revenue per FTE could come in handy for you. So whether you're looking at total revenue, gross or net, or some constructed revenue KPI, you can start to track progress and set goals. So if you're looking at revenue per full-time equivalent, for example, you would expect that measure to dip in the few months after hiring a new employee. But let's say you hired a new salesperson. You would expect a relatively quick rebound because that person should be generating additional revenue. That's the point of a salesperson, is to bring in new customers and to therefore boost revenue. Whereas if you hired somebody in fulfillment or administration, you wouldn't expect as quick a rebound. So you would take that into account when you were doing your financial projections for the quarter or half year or full year after hiring that new person. And that's a way that you can start to advise your customers and even prospective customers when it comes to working with you. Especially if you're going to try to work as a fractional CXO, maybe part of the deal of hiring you as a fractional CXO is that you'll be doing both advisory and implementation over the first, let's say, quarter or half year, but then eventually you'll need to hand off the implementation work to somebody in-house. It would be nice if you could then show your prospective customer what the revenue per FTE effect of working with you for that first 6 months would be, so that you can justify them hiring someone to hand over the implementation work to, and then you're not stuck doing the hands work perpetually under that arrangement. There are lots of different ways that you can start to take these KPIs and generate stories about the business, to generate projections, to generate possible futures. And now back to, this is another blog post that I wrote a couple weeks ago, sell the future, not the features, right? Don't just talk about all the joys and benefits of working with you. Actually create a vision of a future that gets your prospect excited and then come back and make a business case for working with you to generate that future. The second KPI is profitability. Now, often we skip revenue and jump straight to profitability, but of course, revenue is important. Without revenue, we can't have profit. First of all, we're going to look at revenue and different KPIs we can construct around revenue. Then we're going to look a little bit further down the profit and loss statement and look at profitability. Now, like revenue, we have two different kinds of profit. We have both gross profit and net profit. Gross profit is net revenue. So we're going to take out the discounts and the refunds out of gross revenue, and we're going to get net revenue. Then we're also going to take out direct expenses. Now, these are also called your costs of goods sold or costs of sales, depending on who you're talking to or what industry you're in. This is why I prefer the term direct costs. Cost of goods sold itself is a bit of an antiquated concept because it's primarily coming from the manufacturing sector, and so it doesn't really carry over well into the service sector. We're not really producing anything, therefore we're not selling any goods. Some businesses will call this cost of sales then. Again, we're not always thinking about selling. Maybe we're talking about providing a service. So we don't really have sales revenue. Maybe we have service revenue. And we look at direct expenses as the costs you have to pay in order to fulfill your commitment to your customers. Now, this is easy to think about in a manufacturing sense where we're talking about cost of goods sold, because in order to sell a widget, you first have to make the widget. In order to make the widget, you need the raw goods or the parts that you assemble into the widget, and you also need people actually on the factory floor, on the assembly line, that are putting the widget together. So you would have the direct labor of the people actually assembling the widget, plus the cost of the raw materials or the parts that go into making the widget. Now, those costs go into what's called cost of goods sold. Those are the direct costs, the direct expenses in a manufacturing context. Now, in a service business, like a creative agency, like an accounting firm, like my business, then you might hire a specific fulfillment role. For example, as a fractional CFO, if I take on a new customer that includes bookkeeping, I might hire a bookkeeper that is particularly for that client. That would be a direct labor cost in my business. If you're a CMO, you might bring on a social media manager specifically to work with a customer of yours where part of what you're advising them on is their social media strategy. So if you're hiring labor particularly for a specific client or even a small subset of clients, then that would be direct labor. Or you might contract a specific project out. Let's say you're a web designer and you're going to contract out the copywriting for that new website. So you're going to pay a copywriter as a contractor to work with your web design customer. That would be a direct cost because you have to have the copy for that customer's website. You can't really put together an effective website. You can't really sell a complete product to that customer without having the copywriting done. Or you might pay for a specific tool or software subscription for a customer. So again, if you're a website designer, you might pay the WordPress or Webflow subscription for that customer. I run a virtual CFO service. That means sometimes we set up and run the bookkeeping for our customers. So we pay for the subscription for the bookkeeping software that we use. We use QuickBooks Online. So if I'm setting up the books, I might set up the subscription and pay the cost of that subscription for QuickBooks Online for a customer. That's part of my direct costs. So we're going to take those direct expenses, those direct costs out of net revenue, and that gives us gross profit. So gross profit is what's left of revenue after we pay the expenses that we have to pay in order to generate that revenue, those direct expenses. But it's before we take out any other expenses. When we take out the other expenses, what we call the indirect or the operating expenses, that gives us net profit. Net profit is the bottom. Your gross revenue is the top line. Your net profit is the bottom line. And in between, we have net revenue, or revenue after your discounts and refunds. And then we have gross profit, or your net revenue minus your direct expenses. Then we take out your indirect or operating expenses, and then that gives us net profit. And that's how you read a profit and loss statement. So if you're already running your business and you're getting a profit and loss statement from your accountant or from your bookkeeper, that's essentially a run through of the profit and loss. A lot of these KPIs that you need to be focusing on, they come pretty much directly from the profit and loss. Now, you need to be looking at these over the right time frame. You need to be looking at the changes in these amounts. So just looking at 1 month's P&L doesn't really give you much of an indicator of what's happening in your business. But if you're looking at changes over time, or even more importantly, I think, if you're looking at the constructed KPIs, then you can get a lot of information out of your profit and loss, more so than what you on the profit and loss statement itself. In fact, one of the services that I offer as a fractional CFO is creating dashboards for customers that will take some of the financial data, some of the non-financial data, create and report these KPIs, especially the constructed KPIs, to give a better idea of what's happening in my customer's business. We're usually looking at margins. So we'll talk about gross profit margin and net profit margin. This means the percentage out of total revenue. So if your total revenue, let's say using easy numbers here, is $10, but it cost you $2 in direct expenses to make that $10. Let's say you sell a widget for $10, but it costs you $2 to make that widget. Then you have a gross profit of $8. So you kept $8 out of the $10 of revenue. So that's an 80% gross profit margin. Now, the reason we would look at this in terms of margins, in terms of actual numbers, is because we can compare margins across competitors in the industry. We can benchmark against margins, gross margins and net margins. So your firm or agency might be 10 times the size of mine in terms of top line revenue, but my margins might be better than yours, right? I might have margins of 80% versus your firm that has margins of 70%. Well, you're bringing in 10 times the revenue, but I'm keeping 10% more of my revenue, at least in terms of gross profit. So if I could maintain those margins and scale my business up, once I was collecting as much revenue as your agency or firm, mine would actually be more profitable. I'd actually be getting more profit in absolute terms, in actual dollars, than you would. The trick is to figure out how to maintain those margins as your business scales. And this is where having a CFO working with you can be really helpful, because you need to be tracking these figures, these KPIs to begin with. Then you need to be interpreting them and thinking about how you get them moving in the direction or staying where they're at if you're happy with them, so that as your business grows and scales, your margins don't slip. Your margins don't start to decline, which is typical of a lot of businesses. As the business grows, your gross margins tend to decline. It's just natural. The bigger you are, the more expenses you have. And so if you can grow and maintain or even improve your margins, then you can generate a lot more profit than similar sized or maybe even larger competitors. Now, profit is easy to manipulate, unfortunately. So we can decide which expenses to call direct or indirect. And so this can throw off our gross profit or net profit margins. So you and I might disagree about whether hiring a bookkeeper in my firm, if you're another accounting firm owner, you and I might disagree. You might consider bookkeeping just part of your normal salaries and wages expense as an operating expense. So that would still affect your net profit, but you might not include that in gross profit. Whereas I might say I only hired that bookkeeper to work with a specific subset of customers. So I think that is a direct expense, and I'm going to call it part of my direct expenses, and therefore it's going to reduce my gross profit. And you might disagree and say, well, you've got better gross margins than I do, but it's only because we disagree on how to allocate that expense between direct expenses versus indirect expenses. Now, at the end of the day, our net profit's going to be the same if everything else about our firms was the same. But you can see how it might be easy to manipulate, maybe especially over time. Maybe from one quarter to the next, your gross margin slipped, and it's because you brought on a new employee and decided to call that person's salary direct expenses. And maybe you don't like the fact that your gross profit slipped, because one way that we compare businesses is based on their gross margins. So you decide to reclassify that person's salary as an operating expense instead of a gross expense, instead of a direct expense. That's one way that you could manipulate some of these KPIs. Again, you're going to wind up with the same bottom line, but if you're focusing on gross profit margin as a KPI, you could manipulate that a little bit. There are also some non-cash expenses that can easily be manipulated. Depreciation is a big one. Typically, we say that book depreciation is equal to tax depreciation, and some of this is tax and accounting that again, like I said earlier in the episode, you don't need to learn this, but there are some non-cash expenses that you can manipulate to change the way profitability looks. There are also some cash expenses that you can manipulate, such as prepaid expenses. Now, this is all getting a little bit technical, so I'm not going to talk much about this, but just be careful when it comes to KPIs based on profitability. There's a saying that revenue doesn't, but profitability can be manipulated. In fact, what's made a lot of headlines over the past several decades, really this is an ongoing problem in the business and especially the accounting world, is that some of these metrics that we use to decide whether a business is performing well, they're relatively easy to manipulate. Profit is relatively easy to manipulate. And so if you're deciding whether to invest in a business or to buy a business or to do business with a customer or a vendor based on profitability alone, be aware that there might be some manipulation going on there. And it may not even be intentional, but that's part of the calculus of how accounting and comparing businesses works. The third KPI that I want to talk about here is customer satisfaction and retention. Now, obviously, these are important. Customer satisfaction and retention are important for creative agencies because they're key indicators of the success of the agency's work. Now, yes, collecting more revenue and keeping more of that revenue in profit is a really good metric of success, but there are ways that you can increase revenue by signing up a lot of new customers, for example, but maybe none of those customers are particularly satisfied. So you're dumping a lot of money into marketing and advertising efforts that are bringing in a lot of new customers, but maybe none of them are actually sticking around to purchase any upsells, or they're not sticking around to subscribe to your ongoing services. They're just making the initial purchases and then not coming back for anything else. So we want to look at customer satisfaction and retention as a metric of whether what the business is actually doing for its customers is successful. Now, these have important downstream effects as well. Satisfied customers are more likely to continue working with you and recommend it to others. So they might bring in new customers. They might also add on additional services. They might even add on more premium services. And this is a big win-win for you. If you have customers that are delighted with you, that they not only want to keep doing business with you, but they want to do more higher value work with you, right? Such as subscribing to ongoing services generating recurring revenue, or maybe just higher value projects in the future, then this is obviously an ideal scenario for you and your business. Satisfied customers are also generally easier to work with. And if you have employees that are primarily responsible for keeping your customers happy, then increasing your customer satisfaction and working with customers that are just generally easier to work with is also going to increase your employee satisfaction and therefore your employee retention. If you can increase your employee retention, you drive down your costs of finding and hiring new employees. And so that is an incredibly important downstream effect of higher customer satisfaction and retention. That's an especially important benefit that you can indicate to your customers as well. So again, if you're a creative agency and you're trying to make a business case for working with you, then maybe part of your marketing campaign is not necessarily to bring in new customers, but to try to upsell or have additional sales or follow-up sales or sell subscriptions to existing customers. Part of the business case that can be made there is not only that they're going to be increasing revenue from their existing customer base, but they'll also drive down costs by creating happier customers, which there in turn gives you happier employees. Employees also working for more stable businesses, and businesses that have happy repeat customers tend to be more stable. So overall, happier customers can produce happier employees. I think it's Gary Vaynerchuk that said, your employees don't work for you as the boss, your employees work for the customers, and you work for the employees. It's your job to keep your employees happy because it's your employees' job to keep your customers happy. If your customers are happy, then they'll make your employees happy. And that'll make it easier to find, hire, and retain good talent inside your business. That'll not only help drive up your revenue, but also help keep your payroll costs and employment costs relatively down because you won't have to be searching for new employees and trying to find new employees and getting back into the day-to-day and having to take over fulfillment yourself because you can't find talent to fill those critical fulfillment roles. So how do you actually measure customer satisfaction? How do you actually quantify that and put that into a dashboard? One common way is through surveys such as the Net Promoter Score, NPS. Now, because the NPS is such an effective measure and it's relatively easy to use, we're bombarded with NPS. Almost every time you do anything on the internet anymore, it seems like you get a pop-up screen with that 0 to 10 scale asking you how the transaction went or how your experience was or to rate your interaction with that website. And frankly, people are just probably tired of NPS scores. I think a lot more effective way to do this is just having conversations both with your customers and with your staff. Your staff know if your customers are happy, if they seem happy, or if they seem frustrated. And you can get that sense directly from your employees. Again, your employees are working for your customers. So if your customers aren't happy, your employees probably aren't happy, or at least they're the first ones to know. And they're your ticket to knowing whether your customers are happy or not. And then, of course, that's going to turn into, now those are good leading indicators, right? Those are good indicators of whether for example, a frustrated customer might be getting ready to ditch your agency and move to a different one. Whereas a happy customer that is generating a happy employee and vice versa, that might be a leading indicator of a customer who's ready to buy more. Now, there are plenty of lagging indicators as well, such as your percentage of returning customers or your average length of a customer relationship, and these are important to track as well. You should be tracking those KPIs, but and this is something that I haven't gotten into this episode, I'll probably have another episode on this, is the difference between a leading and a lagging indicator. Because we're trying to change or at least affect how our business is performing in the future, then it's generally more helpful to look at leading indicators than lagging indicators. Now, we need lagging indicators, and they are important. So, for example, measures of revenue, measures of profitability, those are all lagging indicators. They tell us how we did last month or last quarter or last year. They don't really tell us much about how we're going to do next month. Whereas something like a customer's level of happiness or how many customers an existing customer has referred to us, right? These might be more leading indicators. How many referrals we're getting in per month. Those are leading indicators because more referrals this month might mean more sales next month, for example. So if we're trying to project how our business is doing, we need to be looking for leading indicators while also paying attention to the important lagging indicators. Now, a critical KPI for any business is customer lifetime value. And I've seen this written as either LTV for lifetime value or as CLV for customer lifetime value. But this is the average purchase value. So if you take every sale your business has made and divide that by the total revenue that you've generated from all those sales, that's your average purchase value times the average number of purchases. So how many times have you made a sale? And then you multiply that by the average length of a customer relationship. How long does a customer usually last with your business? This is particularly easy with subscription model. If your customer on average stays subscribed to you for 3 or 4 or 5 years, that's your average length of a customer relationship. It can be more difficult with project-based customers. If they come to you for a project this year and then they come back to you for another project, say in 2 or 3 years, then is that really a 3-year length of the customer relationship? Maybe they went and dealt with similar providers in the meantime and decided that they didn't like them as much and figured they'd come back and try you again. That person really wasn't your customer that whole time, but maybe the fact that they ultimately came back to you, maybe it does make sense to say that they had a relationship with you the whole time. I don't know. So it depends on how you want to measure that. And again, this is a reason that I prefer subscription models, especially in service-based businesses, if possible, because it facilitates some of these metrics that we use. So you take your average purchase value times your average number of purchases times your average length of customer relationship. So in other words, what we're saying is, how much do we sell to our average customer? How many times do we sell to them? And over what period of time would we sell to them? And that gives us your customer lifetime value. Now, that's historical. That's taking those lagging indicators. That's taking your historical data and producing that. Your goal is to get a projected value. And there are lots of ways of doing this that I've seen. Some of them get super technical and are using some advanced modeling, even statistics, to try to come up with this. I think that's a little bit of overkill. I think depending on the size and scale of your business, just using the historical figures and running with that and maybe making a bit of a range of expected future values is probably the best you're going to do for most small businesses. I'm sure huge corporations have some pretty sophisticated techniques that they're using, but when it comes to me and my customers, we're just using historical values and then trying to project those out, make some reasonable projections out. Maybe a best case scenario, worst case scenario, and then something in between that we truly expect to happen. The fourth KPI is your customer acquisition cost. Now, this typically goes hand in hand with your customer lifetime value. So your customer acquisition cost, your CAC or CAC, is the amount of money that a company needs to spend in order to acquire a new customer. So if you think about measuring this, it's the total marketing total marketing and sales expenses. So how much are you spending on your marketing function? How much are you spending on your sales staff divided by the number of new customers acquired? And usually you do this within a period. Now, probably not a month. That's probably too short a time frame. Quarter might even be too short, depending on your business model and how much business you're doing. But you could go anywhere from a quarter to a half year to annually. And looking at your annual CAC, maybe your quarterly CAC. But that's your total marketing and sales expenses, or really all the cost that it takes to bring in new customers divided by the number of actual new customers. There are a couple of other ways you could try to measure this. Cost per lead is one. So the cost of acquiring a lead as opposed to an actual new customer. And then you can look at your conversion rates, how many of your leads actually become new customers. And that might get a little bit more granular, because if you're working more on volume, quantity as opposed to quality when it comes to new customers. So if you're selling a digital product, for example, you might just want to generate as many leads as possible because your actual close rates or conversion rates are relatively small. 2, 5, 8%, something like that. So you're playing a volume game, a quantity game. You need a lot of leads in the door. So it might make more sense to look at costs of acquiring leads as opposed to costs of acquiring new customers. And there's also, I'm seeing cost per action. So this is cost per click, for example, if you're selling ads online. So this would take the cost of a specific action, such as clicking on an ad or maybe filling out a form or actually making a purchase, and then dividing that by how many times that action is actually taken. So how much is it costing us to get people to fill out a form on our website, and how many times is that form actually getting filled out? These are all different ways you can measure CAC or something related to CAC, such as cost per lead or cost per action. These measures are all going to help us understand the efficiency of our marketing and sales efforts. Are we spending the right amount or too much or not enough on our marketing and on our sales staff? So if we have relatively high, especially compared to our customer lifetime value, then we might be spending too much on marketing. Or we might have really ineffective marketing. We might need to change our marketing strategy. Or we might have hired too many salespeople. Right? And so again, back to top line revenue. What is our revenue per full-time equivalent? And if we want to get even more granular, what's our revenue per salesperson? Of course, at that point, you could then just look at your individual salespeople and see how they're doing as far as sales go and compare them. But there are ways that you could get a little bit more systematic about this, especially as your business scales and grows. Now, because CAC is a cost, we're obviously going to want to minimize this as much as possible. So how can we reduce CAC? We can optimize our marketing and sales efforts, obviously, right? We can look at whether we really need the staff or whether we really need the marketing efforts, the marketing campaign that we're putting in that, or whether those marketing and advertising campaigns are actually effective, whether they're generating any new sales or enough new sales to justify the we can try to improve conversion rate. So again, if you're playing the volume game, then maybe if you can go from a 2% conversion rate to a 5% conversion rate, that for some businesses that could potentially double revenue, right? That maybe even triple revenue. And so then we've got a serious difference in terms of, so every marginal increase in our conversion rate, what's the effect of that on top line revenue? And therefore, what's the effect of that on profitability? We're going to compare CAC to customer lifetime value. So instead of focusing on reducing CAC, maybe we focus on increasing customer lifetime value, because that's ultimately the ROI that we're looking for. If we want to make a more profitable business, then we need to get new customers and we need to sell more revenue to those customers. So we can either try to reduce CAC and be more efficient about generating that customer lifetime revenue, or on the other hand, we can try to increase customer lifetime revenue, customer lifetime value, and try to get more revenue out of the customers that we're actually getting. So as a creative agency, you will increase your customers' CAC. Again, thinking about how you can apply these concepts to your own customers, right? You'll increase their CAC. They're going to pay you to try to help them acquire new customers, right? So you're increasing their CAC. You're doing exactly the opposite of what they're trying to do. They're trying to reduce their CAC, but you are going to come in and increase their CAC. But if you can also demonstrate an even greater increase in the customer lifetime value, then you've created a net gain in profitability. So again, you're trying to urge them in a direction that's counterintuitive to the direction they want to go. Typically, business owners are thinking in terms of reducing costs. You're asking them to increase costs. So in order to do that, you need to generate some sort of gain for them, particularly in terms of customer lifetime value, that's going to offset that additional cost. Again, the key in terms of thinking about these KPIs is obviously how do they apply within your own business, but ultimately how do they apply to your prospective customers? How can you use the understanding of these KPIs to make a business case for doing business with you to your customers? How can you convince your customer's CFO, your customer's financial advisor, your customer's business coach or mentor to convince your prospective customer to do business with you? That's what you're trying to do. So the fifth KPI here, and the last one, is productivity and efficiency. Productivity is obviously important. You want your workers to produce output for your customers in a timely and cost-effective way. And there are tons of ways to measure or try to measure productivity. Two of the common ones are billable hours and projects completed. So how many projects are your employees completing, and how many billable hours are they actually working? I don't particularly like these measures of productivity or efficiency, but they're pretty common in a lot of service-based industries. So how can you improve these metrics? You can streamline communication and processes, right? You can make it to where your employees are doing less administrative work. They're having to do fewer administrative tasks, and they're spending more of their working hours just working on client work. So that's going to mean streamlining communication and your processes so that they're not chasing down paperwork or they're not trying to get answers internally, that they're actually focusing on the work at hand. Investing in technology to automate and track work. So instead of spending a lot of time manually filling out a timesheet, maybe you have some technology that just tracks their time automatically. Or maybe you're automating some of those repetitive or administrative tasks so that, again, your employees can focus on the actual client work at hand. And then setting clear goals and expectations with staff and customers, right? You're not going to have 100% productivity and 100% efficiency. Things are going to go wrong. You're going to have power outages. You're going to have internet outages. You're going to have things that are going to create delays in work. So build that into the expectations with your staff and with your customers. What happens if you can't meet a deadline for a customer? What happens if your staff need to miss a day of work for personal reasons or for illness? Build all of that into your systems and processes. At the same time, don't run your system at 100% efficiency, because you're probably going to have capacity problems then. People are going to get burned out. You're going to have employees that are too busy to take on additional work when the whole time you're trying to bring in new customers. Build in some excess capacity, which means you're not going to have full efficiency. Again, there's another reason I don't really like efficiency and productivity metrics, because it's counterintuitive for the way we need to think about growing a business. In order to grow a business, we need some excess capacity in order to serve new customers. But if we're focusing on efficiency, excess capacity is inefficient. But we need excess capacity in order to bring on new customers and grow the business. So typical productivity and efficiency metrics focus on output, but they miss a critical aspect. They miss quality. And this is probably the biggest reason that I don't like productivity and efficiency metrics, because efficiency isn't everything, and it definitely shouldn't be in your agency either. The ultimate judge of the output of your business is your customers. And they're going to be basing the work on whether it got done on time and on budget, sure, but ultimately, is it good quality work? Is it something that they're proud of? Is it something they're happy to pay for? So I prefer measures of effectiveness over efficiency. So that means measuring your customer response to the work. So again, back to your customer satisfaction and retention metrics. I think there's a lot more to customer satisfaction and retention than there is to productivity and efficiency. Now, again, you need to be making sure that your workers are actually producing cost-effective, timely work, but that is not an end in and of itself. That is a means to an end. That's a means to the end of having satisfied customers. So I think ultimately your focus should be on customer satisfaction and employee satisfaction as well, as opposed to just productivity and efficiency. So that's not just 5 KPIs. That's 5 sets of KPIs. There are probably at least a couple dozen KPIs ultimately that I've discussed throughout this episode. that could and should be tracked in your business, and really that should be discussed with your customers as well, both in terms of trying to make a business case for working with you, but once you're already working with those customers, these are KPIs that you should be helping them track and measure and benchmark in their industries and compare over time since they started working with you, or before they started working with you to while they're working with you, so that you can show improvements that are caused by working with you. Then you can turn those stories about how you've helped improve these KPIs for your customers into case studies, which will make it easier to convince future prospective customers to work with you. So once you get comfortable tracking and interpreting these KPIs for your business, you should be encouraging your customers to track and interpret them as well. Remember, the ultimate goal here is to help you sell more of what you're doing. And in order to do that, you need a compelling business case for doing business with you. Remember, I'm not trying to train you to be an accountant, but I am trying to help you sell to customers who listen to their accountants. Frame your benefits, your features, the things that you're going to do for your customers. Frame those in terms of your customers' KPIs. Sell futures, not features.